Something weird is happening in the JGB market. Japanese long-term government yields are rising, but why are they rising? Most people say it's because the Japanese market is awakening to Japan's long history of recklessly spending money it doesn't have. Others say it's the inflation that the Japanese economy continues to suffer under. But if you ask the JGB owners themselves or the former JGB owners, what they'll tell you is the reason they're not buying is the greatest source of uncertainty in the entire financial economy is, in the case of Japan and JGBs, the Bank of Japan. Central banks around the world, when they're supposed to be this steady hand of stability for financial markets, what they're proving to be is the greatest source, as I said, of uncertainty. And this is another one of those times you don't have to take my word for it. We're going to go over what the JGB participants themselves are saying, the big Japanese financial companies who are not against JGBs, nor do they concern themselves with the Japanese budget deficit. Instead, they can't figure out the Bank of Japan, nor can they get any clarity on the Bank of Japan. And the same is true in the US dollar marketplaces too. We're going to talk about term SOFR futures here. The term SOFR futures curve has not changed, has not shifted from its ultimate prediction, its forecast. Interest rates, short-term interest rates that are tied to the Federal Reserve are going to go down according to this marketplace. The inversion is still there. What the market can't figure out and what it's struggling with in terms of uncertainty is when. When is Jay Powell going to stop talking about inflation? So you've got SOFR futures, you've got interest rate swaps, you've got the Treasury yield curve, all of them saying the same thing. There is no inflation. Interest rates have to go down and go down by a lot and then stay there. But what they can't figure out, like in Japan, is when. When will central bankers get off of their inflation fix and start looking at the economy and reality more objectively? So, Steve, Mr. Van Meter, let me throw that question to you. When is it that the central banks are finally going to wake up and figure this out? And of course, that's an unfair question. You have to get yourself in the mind of the bureaucrat, but that's really what the markets are struggling with.
Well, Jeff, I think there is one other aspect here is it's a labor market because we know central banks, particularly the Fed, has this dual mandate, which is pretty silly. It's like we're going to somehow manage inflation using interest rate policy. And at the same time, we've got to manage the labor market using the same exact tool. So the problem here is we have seen disinflation. And I think Jay Powell knows that inflation is likely to trend down. Of course, he's worried there could be some sort of expectations that show up and we see a spike due to the tariffs. But broadly speaking, I think he realizes the trend is headed down, as well as I think a lot of other central bankers. But we continue to hear from him. We see validation from this in the non-farm pay report that the labor market's still holding up. And we see in the continued claims data, well, it's ticking higher. But what about the initial claims we got this week, Jeff? What did it tell us? Employers really don't want to lay off here. They're really antsy about it. They're concerned that the economy might turn around and then they don't want to come back and have to hire and retrain people. The problem is, if we're looking for this inflection point, I think it's a labor market. But Jeff, I'm not sure how much longer the U.S. labor market or the labor market for a lot of places around the world is going to hold on.
Yeah, and I think from the market perspective, that's what the markets are all saying is that eventually that has to happen. The weakening isn't turning around. There is no sign that suddenly everything's going to start taking off here. Instead, what they're saying is that at some point, these bureaucrats will stop talking about inflation. And really, I think we have to start with that fact that you have to realize that central bank rate cutting cycles are irregular to begin with, simply because central banks do not want to cut rates, because cutting rates is an acknowledgement of failure. And furthermore, not only do they not want to cut rates, they think that when they do cut rates, they only need to cut a little bit because it's such powerful stimulus. And therefore, we're going to cut 2 or 3 times, maybe 4 times, and it'll be huge stimulus. And therefore, we won't have to cut anymore. So the market is already having to grapple with the idea that central banks do not want to cut rates. Rate cutting cycles are entirely irregular. They're marked with pauses. Like, the ECB this week decided they were going to pause their rate cutting after getting down to 2%. That is not unusual. In fact, the ECB, this is their second pause in the rate cutting cycle already. So the markets have to try to figure out what bureaucrats are interpreting as far as economic signals. And then on top of all of that, we have to realize that central banks all over the world are biased institutionally toward inflation to begin with. So everything in the world is lined up against central banks rate cutting. And unfortunately, because central banks have this ability to influence short-term interest rates more directly, all of these markets are saying, we know what the long run looks like, but we don't know how the Federal Reserve or the ECB is going to eventually get there. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video.
But Jeff, isn't that what the SOFR curve is telling us? That look, like you said, we know interest rates are going to go down, but we don't know when. But isn't that exactly what we're talking about with the labor market right now? We know it's going to go down, but we don't know when. Now, we can look north to Toronto. We can see a heavy manufacturing base, and their unemployment rate has been moving higher. And there's an issue to that because it's exactly what I think everybody believes is eventually going to happen in a lot of other countries. Problem is, it hasn't happened yet. What we've seen is just continued front running of tariffs. But at some point, the music on that is going to stop. We know inventory levels are bloated. We know housing markets are slowing down. We can see all the evidence of this happening all over the world, but it hasn't had a massive impact. And again, I think that's exactly what the bond market is telling us. We know this is all going to come unwound. We know the central bankers are going to cut, but we don't know when.
Yeah, we don't know when, and we don't know exactly how. And you're right, Steve. You can see this. You can literally see this on the term SOFR futures curve. So the inversion, the level of inversion remains the same regardless. And so what happens is, like in April, when we had the tariff shock and stocks were falling off and consumer confidence was collapsing, the term SOFR futures curve moved forward, as in the inversion stayed the same, but it moved forward in time. What the market was saying is like, okay, here we go. We have some economic decay. We've got some deflationary we got deflationary disorder. Maybe this will be what gets the Federal Reserve out of its institutional bias. And so the inversion moved up into 2025, thinking the rate cuts are going to be resumed from here. It's going to be another series of them. And then Powell started talking about tariff inflation. And what happened when he started talking about tariff inflation? The term SOFR futures curve remained just as inverted, but it shifted back in time into 2026. And so we've seen this happen several times already. The inversion remains the same, but it shifts backwards and forwards in time based on what are the current circumstances and how we interpret the Federal Reserve's how they're going to react to incoming data. And what has happened over the last 6 months, or the first 6 months of this year, is that they've been talking exclusively about inflation, and the market's like, we're not really sure what it is that will get Jay Powell out of his inflation bias and his inflation fix. Christopher Waller and the dissension among the rest of the FOMC hasn't really done it yet, though we've seen some increase in hedging for the 2026 contracts on SOFR futures curve. But overall, it's the same thing as Japan and other markets like the European markets. It's a big time guessing game trying to figure out when central banks will cut and how fast they'll cut and how it is that they'll carry out their cycle. But the important point is all the markets remain steadfast that this is what's going to happen. We're still going to get a central bank rate cutting cycle. We just don't know how it will actually be carried out.
Yeah, and we know it's going to happen, Jeff, because every time prices go up, what do we see in consumer habits? And it doesn't matter. It's not here just in the U.S. It's all over the world. Prices go up and demand goes down. And so a lot of people look at the interest rate market, and because of the Fed and the central bankers, they think it has everything to do with inflation. In fact, this week, we know that President Trump went to pay a visit to Fed Chair Powell at the new building, or, well, I shouldn't say new building, but rehabilitated building, or in process of, and he wanted a rate cut. And of course, we heard him afterwards say, look, you got to do the right thing, but it's all about inflation. Everybody's got their mind fixated on it. But a lot of people don't realize that interest rate policy has a lot to do with not just inflation, but growth. And I think that's the component here is the inverted curves are saying, hey, look, we know that things are going to turn down, but for some reason, growth hasn't rolled over yet. But if that is actually true, then we have to look at Japan, because if long rates are going up, Jeff, doesn't that mean growth and inflation expectations are getting better? Isn't that a good thing?
It should be, right? I mean, that's the overall interpretation we'd like to make. But again, you don't have to take my word for it. You can take it directly from the largest JGB holders. They're not saying we see more inflation or we see a higher growth potential in Japan. What they're seeing is volatility in the short end of the curve that's introduced specifically by the Bank of Japan. Here, let me give you a couple of quotes here. The first one is from last month from Mizuho. Mizuho is one of the biggest JGB owners that are out there. And according to Bloomberg, Mizuho is managing its securities portfolio, quote, very conservatively as Japan's third largest lender prepares for the next investing opportunity after shrinking its bond holdings. The bank wouldn't build up big positions until it's confident the Bank of Japan isn't likely to raise rates anymore, according to CEO during a question and answer session with the media on Tuesday. Mizuho has cut its positions in foreign and Japanese government bonds, he said, slashing its JGB holdings to 8.3 trillion yen as of March from 25 trillion yen 3 years earlier, according to his investor presentation. And the punchline is, the CEO said, as soon as we're done with the Bank of Japan, or as soon as we see the Bank of Japan finishing its rate hiking cycle, its volatility in the short end, we're going to pile right back into JGBs. And that point was echoed by an even larger JGB participant, Japan Post. And this just came out this past week. Japan Post, one of the nation's largest life insurers, said that super long-term yields are nearing their peak, and the company plans to shift holdings from foreign to yen bonds in expectations of a U.S. interest rate cut. This all works together. Quote, Japanese government bond yields are attractive on a relative and absolute comparison basis, according to the executive officer and senior general manager of Japan Post. The insurer plans an active shift from foreign to yen-denominated bonds to get ahead of a decline in U.S. yields and expects the U.S. Federal Reserve to cut rates twice in the current fiscal year ending March 2026. And as I wrote about in our deep dive analysis, I bet you Japan Post traders expect a lot more than 2 rate cuts out of the Fed. That's all they're going to say in public. So the upshot here is we have 2 people on record, 2 major JGB holders on record saying we got out of long-term JGBs not because we thought inflation was going to be out of control, but because we know the Bank of Japan thinks inflation's out of control and therefore it's going to react to it, therefore creating volatility. And let's also add this, paper losses that they don't want to hold on to. So they're getting rid of their paper losses in JGBs, all the while planning to go right back into them once the Bank of Japan stops creating this volatility in the short end of the yield curve. As I said in the introduction, the greatest source of uncertainty in the entire financial system are these central banks.
And yet, Jeff, they shouldn't be a source of uncertainty. In fact, if we go back to central banking of the bygone years, this is the last thing that they would want. They don't want this at all. And yet we continue to see all of these central bankers, Fed speakers, the whole list of them. There's not a week that goes by that you're not hearing from a handful of central bankers all over the world. And at this time, they need to be very clear about their messaging because they're causing problems in the global bond markets that are completely unnecessary. And of course, we know the same effects. We talked about how prices go up, demand goes down. The same thing's going to happen in the bond market. As rates go up, if someone was going to say, go out and buy a home, they might change their mind because, well, rates have gone up and they can't afford it. So right now you think, the short-term curves are saying, look, we know rates are going to come down. They can't because everybody wants out of these because central bankers are acting irresponsibly. And yet, beyond all of that, we continue to see the global economy slow down. 2 rate cuts by the Fed, not a chance. We know that's just but probably the next rate cut is going to be 2 cuts at once, and then it's going to accelerate to the downside from there because once we see the U.S. economy finally hit that air pocket, and I don't think we're there yet, but I think we're getting close, then watch out. The Fed's going to go back to zero as fast as they can.
That's the thing, Steve. You said this earlier. The mainstream keeps talking about inflation. So the general public thinks that's the greatest threat to the U.S. economy. Inflation, because that's all the Federal Reserve will talk about. But it's not really the consensus opinion where it really matters, which is in these marketplaces. Whether it be Japan, Europe, or the United States, what these markets are saying is There is zero inflation risk. If there was any legitimate inflation risk, we would see these curves like this term SOFR futures curve would not be inverted. It would at the very least be flat. And if there was legitimate inflation risk, it would be upward sloping. What that would say is that there would be a positive chance that the Federal Reserve would have to raise rates in response to something like tariff inflation. But instead, the term SOFR futures curve, like interest rate swap spreads being so negative, they are very confidently pricing that rates are going to go down by a lot and then stay there for quite a long period of time. That doesn't include inflation, nor does it, as Steve mentioned earlier, it doesn't include a healthy economy either. So really the uncertainty here is not either growth or inflation. It's about central banks' interpretation of growth and inflation and how difficult it is for market participants to interpret that interpretation in any kind of rational and meaningful way. And that's really just what economics is. Economics is an irrational way to look at the economy and finance because economists don't understand the economy or finance.
You know, Jeff, you can't really play market participants here at all because, you know, the Fed, who usually claims they're data dependent, all of a sudden Powell comes out one day and is like, oh, by the way, I'm worried about inflation expectations. Well, where is that coming from? Well, consumers thinking that because of tariffs, prices are going to shoot up. And so all of a sudden he's kind of deviating from the playbook that he's normally plays by, that everyone expects him to. And then the question is, where does he go next? When expectations come down, is he going to jump on something we're not expecting? We don't know. And so that uncertainty is causing problems, as you said, in the bond market, which is reverberating through the economy with interest rates being artificially too high for where they need to be. And you can see this just creates stress on the system. Of course, we know that once central bankers are all cutting, and probably this year they're going to be all cutting together, there's going to be a ton of money that floods back into the global bond market, more money than anybody can imagine, because if you ask people right now, Jeff, they think rates are going to stay up. They actually believe that the Fed may only cut a few times, if that, and that we're going to see a perpetually higher interest rate cycle. We're going to see long rates continue to go up. But Jeff, you and I know that's just not how this is going to play out.
No, that's the idea. That's the narrative that's out there. That's formed because everybody listens to central bank. And again, it's understandable. Where does the general public, or even most of the investment public, get its information from? They get it from the financial media. It gets directly from Jay Powell. And if Jay Powell says inflation, 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 that's what everybody runs around talking about too. But here's the thing, as you just said, Steve, we saw the consumer price index. We saw the producer price index in the United States. They have softened. They have remained soft. In fact, the producer price index has been negative. We got deflation in producer prices, which you would think as a rational thinker would have caused the Federal Reserve, Jay Powell, the FOMC to say, oh, were we wrong about tariff inflation? Because here we are 5 months into it and we don't see any evidence for it whatsoever. And so the market says, yeah, see here, we got evidence that the opposite is taking place, that margins are being squeezed. Businesses can't pass on their costs to either other producers or to consumers. That's not happening. These are signs of weakness. Therefore, you would think a rational acting Federal Reserve institution would respond to that by saying, oh, we should probably start cutting rates because we believe lower rates help. But instead, what did the Fed do? A perfect example of this uncertainty. What did Powell do? He moved the goalpost and said, oh, well, we haven't seen tariff inflation yet, but we will see it this summer. Or maybe we'll see it in the fall. We need to be sure that we're not going to see it before we do anything. So from the market's perspective, and it's worse in Japan as we're talking about here, from the market's perspective, you have to think, oh, what is it that's going to finally convince these people to get off of their inflation narrative that it has zero evidence and finally realize what's really happening in the economy? And that's incredibly difficult to try to game plan for. In fact, it's impossible to try to rationally analyze irrational actors.
Yeah, Jeff, and you mentioned something interesting. You said companies are getting squeezed at the margin, which they are. And then this week we heard from Intel, who said, hey, we're effectively being squeezed at the margin. And part of our cost restructuring plan is we're going to lay off 15% of our workforce. The problem is that hasn't happened broadly across the economy. A lot of businesses still trying to hold on to people, hoping demand's going to turn around. We just don't know how much money do they have and how much time they have. And I think that's kind of what the bond market is saying. That's what the SOFR curve is saying is, look, we know this is going to happen, but we don't know when. It's when businesses finally break and say, look, we can't hold on any longer.
Yeah, so long as they're still convinced that there's some kind of upside left, there's no real pressure here, certainly not from shareholders, right? That's another big pressure that corporate management would respond to if it was actually happening outside of April. If we saw share prices decline because shareholders are increasingly worried about the economy, that would be one key factor and key lever that management teams would use to say, okay, maybe we should start cutting workers. So at the very least, we can get our earnings back up and make shareholders happy. So there isn't that pressure either, because stocks just continue to rise regardless of any kind of fundamentals whatsoever. And if, as long as you're convinced that, okay, we don't see any negative, we don't need to start laying off workers today, they just keep kicking the can down the road. And that's where the markets keep coming in and say, yes, they can continue to kick the can, but it doesn't change the destination. It only changes the road to get there. So we don't know exactly how we get from A to B, but we still know what B is, because the markets keep telling us B has not changed and will not change over the short run or the long term. It is the same regardless. And the only thing that is happening is central banks are making it more difficult for anybody to predict how we get from A to B. But B is still there nonetheless. That's all right. I can hear you. So that's I'll just try not to look at you, because it's kind of funny. You look like a 1990s video game that's glitching. It's kind of funny.
Max Headroom.
Yes.